Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your guide to making technology work for your taxes, not against them. Today we're unpacking the tax impact of AI and automation on small businesses and how to prepare proactively. I'll translate buzzwords, outline rules you can use, and share case studies that saved real cash. Expect practical steps, humor, and a checklist so you install smarter, deduct better, and stay audit ready while robots handle routine work. When I say AI and automation, I mean tools across a spectrum: off-the-shelf SaaS analytics, chatbots, OCR scripts, machine learning models, custom workflow apps, robotics on the shop floor, and autonomous or sensor equipment. Tax treatment differs because some costs look like services you consume, some create assets with future benefit, and some are equipment. The way you, what, and how long you benefit drives whether you expense now, depreciate, amortize, or capitalize and claim credits. Start with a fork. Is the cost an ordinary and necessary expense of operating this year, or does it create benefits beyond the year? SaaS fees, usage charges, small implementation, and support qualify as deductions under Section 162. Costs to acquire or improve software, systems, or equipment that yield multi-year benefits must be capitalized and recovered through depreciation or amortization. Document intent and useful life. Vague invoices push you toward capitalization when you might deduct. Post-TCJA, Section 174 requires capitalization and amortization of research or experimental expenditures, including software development. Domestic costs amortize straight line over 5 years. Foreign development stretches to 15. There's no write-off even if the project flops. 174 can include employee and contractor wages, supplies, cloud compute used in development, and a share of overhead. It does not cover quality control after commercialization. Track projects by objective and location, because foreign work adds a decade to recovery. What counts as a 174 software work? Activities to develop or improve functionality, performance, reliability, or scalability, experimentation with algorithms, data architecture, prototyping, and integrating models into production, exclude bug fixes after release, cosmetic changes, data entry, and routine maintenance. Document contemporaneously charters, hypotheses, tickets, sprints, repos, logs, and timesheets by task and location. Flag developer agreements, clarifying scope and rights. When in doubt, categorize by project phase, discovery, development, testing, release, to separate 174 from implementation. The R&D credit under Section 41 can offset income tax and, for qualifying startups, payroll tax. To qualify, activities must pass the 4-part test: permitted purpose, new or improved function, performance, reliability, or quality, elimination of uncertainty, process of experimentation, and technological in nature. Eligible costs include qualified wages, supplies, and 65% of contractor costs. The credit doesn't require a breakthrough. It rewards iterative experimentation, pair tracking with narratives linking staff, tasks, and sprint outcomes. How do 41 and 174 interact? You claim the R&D credit on qualified research expenses, but you still capitalize 174 development and amortize. The credit calculation adjusts for the 174 capitalization, yet both can apply to the same project. Startups with under $5 million in gross receipts, within 5 years of first receipts, can elect to offset up to $500,000 of payroll taxes. File elections, coordinate with payroll, and monitor utilization each quarter very carefully. Buying off-the-shelf software, you can expense it under Section 179 if placed in service and you qualify. If you acquire software or IP as part of buying a business, it's a Section 197 intangible amortized over 15 years. Custom builds are usually 174 development. Implementation costs for configuring, mapping, training, and data migration often are deductible under 162 if they don't create functionality. Scoping contracts lets you properly separate implementation from development and maximize deductions. Cloud and AI subscriptions are typically deductible as you incur them. Prepay, the 12-month rule may permit a current deduction if the benefit doesn't extend beyond 12 months or past the next tax year end, whichever is earlier. Multi-year arrangements, leases with purchase features, or upfront payments securing future rights often require capitalization and amortization over the term. Read terms for prepayments, renewal options, and rights. Books and tax may diverge. Ignore robot tax chatter now. Servers, edge devices, sensors, and robots are property. You recover cost via depreciation, but Section 179 can allow immediate expensing up to the annual limit, phased out as purchases exceed a threshold. Bonus depreciation accelerates cost recovery for qualified property placed in service, though the percentage is phasing down. Model 179 versus bonus based on income, loss limits, state conformity, and plans. Track placed in service dates and component costs. Installation and shipping usually capitalize into basis. Autonomous or smart features don't escape luxury auto caps. Passenger vehicles under Section 280F face annual depreciation limits, even with bonus. Consider heavier vehicles over 6,000 pounds GVWR, vans with no rear seating, or specialized equipment like forklifts and trucks, which qualify for 179 and bonus without luxury caps. Substantiation matters: mileage logs, business use percentages, and placed in service evidence. If mixed use, depreciation is limited to business use. Leasing, compare lease inclusion versus owning caps carefully. Implementation, training, and data costs get messy. Allocate between 174 development, deductible implementation, and capitalizable data or licenses. Data acquisition that provides enduring value may be a capital asset. One-time labeling to support model training can fall under 174. Vendor statements should break out consulting versus development versus hosting. Track staff time by task codes. When you improve functionality, lean toward capitalization or 174. When you configure or migrate without capability, deduction is usually supportable. Sales and use tax around SaaS and digital services varies widely by state. Some tax SaaS as tangible personal property equivalents. Others exempt it or tax only data processing. Automation can expand your nexus via transaction or revenue thresholds, even without employees on ground. Don't forget use tax on out-of-state AI tools, hardware, or downloads used in a taxable state. Map where you sell and where you use tech and register, collect, and remit accordingly. Automation can change your Section 199A qualified business income deduction. QBI is 20% of qualified income, but high-income owners may be limited by W-2 wages and unadjusted basis immediately after acquisition, UBIA, of property. Replacing employees with contractors could reduce W-2 wages and limitation, even if profit rises. Conversely, investing in depreciable equipment boosts UBIA. Model scenarios before changing staffing. Keep reasonable compensation and S-Core aligned with duties if automation shifts how owners spend time. With more automation comes more risk. Ordinary and necessary expenses for cybersecurity, MFA, endpoint protection, penetration testing, SOC monitoring, backups, incident response, and cyber insurance are generally deductible. If improvements are bundled into capital projects, capitalize the portion that extends useful life. Some states offer credits or grants for security upgrades or workforce training. Check rules in Windows, document policies, audits, and remediation. A control environment not only protects data, it substantiates your tax positions and credits. Using foreign AI vendors introduces wrinkles. Payments for software, cloud, or services may be treated as services, rents, or royalties under treaties, affecting withholding obligations. Some platforms self-certify, others require you to collect forms and withhold. Cross-border development triggers 15-year 174 amortization for foreign research, even if managed domestically. Track where work occurs. Also consider VAT, GST, and import duties on carriers or hardware. When contracts cross borders, call a pro before you click accept. If you were expensing software development and now must capitalize under 174, you may need a Form 3115 to change your accounting method. Many changes qualify for proper consent, but timing matters. You file a return and take a Section 481A adjustment. Reclassifying from prepaid to amortizable, or correcting bonus versus 179, can require a method change. Build memos describing facts, authorities, and computations. Pros: keep methods consistent, reduce audit risk, and smooth cash flow. Case Study 1. An e-commerce brand added an AI customer support chatbot and automated inventory with scanners and sensors. We expensed SaaS and chatbot subscriptions, capitalized scanners and sensors, and used Section 179 for most hardware, with remaining basis eligible for bonus. Implementation and training were deducted. Minor customizations fell under 174 and amortized. We screened and captured an R&D credit for experimentation, improving response accuracy. Invoices, time logs, and placed-in-service photos made the plan stick. Case Study 2. A services firm built an AI workflow to summarize intake notes and draft deliverables. We mapped staff time, contractor invoices, and cloud compute to 174, triggering 5-year amortization. The year 1 deduction dropped, so we modeled cash flow, elected the R&D credit to partially offset tax, and updated quarterly estimates. Implementation and training were deducted separately. We built a method change memo, added tracking codes, and scheduled estimates to avoid penalties as profitability climbed. Before we close, a Missouri note. Check Missouri Works, R&D credits, and sales tax on automation. Verify before buying. We covered definitions, expensing versus capitalization, 174 and 41, SaaS, 179 bonus, vehicles, sales tax, QBI, cybersecurity, international, method changes, and case studies, action, inventory projects, map cost to tax buckets, track time, evaluate 179 versus bonus, screen credits, calendar filing, model estimates, value, fewer surprises, and better cash flow. I'm David Robson. Thanks for listening to Tax Smarts Unlocked.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.